Hello. So we have chapter 6 today in our Advanced Accounting Redbook, 11th edition, and we're going to be talking about some write off methods. So the first part of chapter 6 talks about what we call our direct write off method of recording our uncollectible accounts. So every single year, and whenever we're dealing with customers, we always have that possibility that we aren't going to be able to collect. So something happens and the customer doesn't have the money and or they end up going bankrupt or something like that happens, and either they can't pay us at that time. And so there's a couple of different ways we can handle those types of transactions. So one of those is our uncollectibles. So when we cannot collect them, they are called uncollectible accounts. They are also sometimes referred to as bad debts. That is something that you will see on your national test. That's something that you will see probably on your test for, say, if you have a state test that you have to do for your accounting CTE. You might see the term bad debts. Now um, Recently we would use the term, presently we use the term uncollectible accounts. And we do that and then we might even write off a customer account. So there's absolutely no way that we're going to be able to collect, and we might end up writing off their account in whole. So one of those ways is that we are going to use the direct write off method. So it says recording uncollectible accounts expense only when an account or only when an amount is actually known to be uncollectible is called the direct write off method of recording losses. So a couple of companies might say, out of all of our clients, we're going to assume that we're not going to collect a certain percentage. And so they would write off a certain percentage of their uncollectibles. So the direct write off method means that we're only going to write it off if we absolutely know we've contacted the customer, we've done all this follow up, we've sent this, we've sent that, and we know for sure they're not going to be able to pay us. So here's that transaction. So it's going to go into our uncollectible accounts expense. Remember, this will end up being a kind of like a loss for us. So we might even be able to take it out on our taxes. So we have account expense, and then we're going to take it out of our accounts receivable and the company who owed us money. So basically, we're zeroing it out. We know we're not going to get paid for it. So that's that transaction. Notice it's in the general journal. Okay, it can't be in the cash payments or cash receipts because we're not getting cash or receipts for it. It's not a sale. It's not a purchase, so it's got to go in the general journal. So this is what happens and this always happens. I don't know why, but it just does. When you write it off, when you write off the account, all of a sudden, the next day or the next week, you get a check from the company that you already wrote it off for. So then you have to do two steps. You have to reopen the account. So basically you're doing the opposite of what we just did with writing it off. We have our uncollectible accounts expense will now be a credit for that same amount. And then we're going to put it back into accounts receivable and to the customer account. So in this case, it's Plaza Electronics. So this is the first step. So we have to reopen. So we're going to do the same transaction that we did to write it off, but we're just going to reverse it. Oops. And then we record it in our cash receipts journal because we've received the check for it. So here is the date, Plaza Electronics. Here's our receipt for the check, and we write it off. Now it's 182. It comes out of their accounts receivable, and we get to put it into our cash. So remember, when we're collecting a written off account, we have to do two steps. We have to reopen it, then we can close it by doing our cash receipts. And then we talk about this. So if we end up writing off an account and then, we'll get a check later in the mail and have to do these steps, we have a decision to make. What are we going to let that customer continue to charge? Or will that be a customer that says, sorry, if you want to buy something, you're going to have to pay in cash? And so that it depends on the customer. If they're an occasional customer, we might just say, you know what, you got to pay in cash. Sorry, there's no more charging for you. If they're a regular customer and that's something, and we don't want to lose their business, we might have to think about continuing to let them charge. But that definitely is a huge decision that will have to be made. So now we're going to do the allowance method. So this is that, you know, estimation, that assumption that we're not going to get paid a certain amount. So we have that direct method, which means we only write off what we know we are not going to get. The allowance method is that estimation of what we think we're not going to get. And it says crediting the estimated value of uncollectible accounts to the contra account is the allowance method. So an item that is not large enough to affect business decision is referred to as being immaterial. So if it's only like a purchase of $5 or $100, when we're doing thousands and tens of thousands or whatever, it might not be material at the time. But I mean, think about it this way: a penny, and the next day another penny, and the next day another penny. And by the end of the year, you have $3.65. So that penny adds up. That penny adds up. So even if one specific item could be immaterial, if you have a lot of those little items, it could actually end up being quite a bit. So there's a couple of ways that we do the allowance method. So they have a percentage of sales method. So they're going to assume that, out of those sales, we're not going to collect and these are the percentage of sales on account, okay? And it should say that sales on account, all right? Not just overall sales on account. So the percentage of sales on account, I'm going to say that sales on account method is we're just going to assume we're not going to get a 1% of our sales. They're not going to pay for them. Or we could do it based on our accounts receivable. So we can do it based on our percentage of sales on account, or we can do it based on our percentage of accounts receivables. So it says the difference between an asset's account balance and its related contra account is called the book value. So that's the value of all of our accounts together. So how much basically our customers owe us. And then it says that book value is often referred to as that net realizable value. So what we're actually going to be able to collect. So here is what that percentage of that sales on account method, okay? So they have the net sales times 0.4%. So they're saying less than 1, right? Less than 1%, because 1% would be 0.01. So less than 4%, and that ends up being like 2,000. So this is what they're going to assume. This is what they're going to assume that we're not going to collect. Okay, so here's my accounts, uncollectible accounts expense, and my account for my allowance for uncollectible accounts. So remember, this bottom one and this is done in an adjusting entry. So before, at the end of the year, when we are doing all of our end of the year stuff. Remember, our allowance for uncollectible accounts is a contra account to our accounts receivable. It's an asset. Uncollectible accounts expense is just what it says. It's an expense. Then we have the aging accounts receivable. So this one goes by days. So this one keeps track of each individual customer, and it keeps track of how many days they're past due. So, and that's how we determine if we're not going to be able to collect. Oops. So here are our customers. Here's how much they owe us. This is how much they currently have spent in the last month. And then this tells us how many days past due they are. So these guys are pretty close in that past the days account balance past due. So they're pretty close. And notice these percentages on the bottom. So these are our estimates. These are our estimates of how much we're not going to be able to collect. Notice for over 90 days late, we're going to assume that we're probably not going to collect 80% of those, or 61 to 90 days, 40%, or 31 to 60, 10%. So it's based on our days and then our percentages. So this is how we figure that out. So we would take those percentages and we would multiply by those current amounts. And then all of those amounts get added together. So this is our total estimate based on our amounts that they owe and the time, right? Here's the time of how much we're going to collect or not. This is how much is already not collected. We haven't been able to collect. So, or that we have set aside. So this is how much we have in addition to that allowance account. So this is going to be the amount of our adjustment. Okay. So here, writing off an uncollectible and that allowance method is just going to go, we're going to take it right out. Vance Corporation isn't paying us, so we're just going to write their account off. So it's going to go into allowance for uncollectible accounts as a debit. We're going to credit for their account, and then maybe at some point they'll pay us. So that's just a regular transaction. So it says the procedures for writing off an account are the same, regardless of the method used to calculate the uncollectible accounts. So notice here we put the word write off. We would put that in the journal, or not the journal, but the ledger when we post it, because we want them to know if somebody opens up the ledger, oh, they had to write that off. So if somebody comes after you, then they can look at that customer and say, we don't want that customer to be a charging customer anymore, because they've had 3 write-offs or 2 write-offs or even just 1 write-off on their account. So we want to definitely make sure that that information is put into our ledger when it's posted. So here is using the allowance method. So it says before account is written off. So this is how much the account was. And then it says after account written off. So, um, so this is beforehand. So we have our allowance for uncollectible accounts. So this is using the two different methods. So our book value, notice the book value is the same, but these two amounts and these two amounts are a little bit different. So if we have, like I said, oh, here goes Vance Corporation. As soon as we wrote them off, they sent us a check because we probably sent them a letter and said, hey, we're writing off your account. You will no longer be able to charge with us unless we receive payment within so many days. So they probably read that and went, oh, holy moly, I can't do that. That looks bad. They're going to report me to a credit agency, report the corporation. And so they end up paying us. And that's a good way to get them to pay, because it kind of scares them. If we report them to a credit agency, then their credit rating goes down, and people look at that when they go to extend credit. And if their credit rating is poor, they're not going to get it. They're not going to be able to extend their credit. So, some financial analysis of our accounts receivable. So, it says calculate the accounts receivable turnover ratio and the days sales in accounts receivable. So, we want to know how long it takes for our customers to pay us. So, it says a business needs cash in order to purchase additional merchandise. It does not collect amounts due from customers promptly. Too large a share of the assets of the business will be in accounts receivable and not immediately usable. So, if we don't keep collecting on our accounts, we're not going to have any money to buy merchandise to put to sell. So, we do something called, we calculate what we call a account receivable turnover ratio. So, it's calculated by dividing the net sales on account by the average book value of accounts receivable. So here we have our total of accounts receivable, our beginning and ending. Here's our different allowances. So then that way, because remember, we have a couple of different methods. And then we have our book value. So we can do it by both. So this one, they use the book value of the 26,990. They divided it by the ending book value here. And then they divide, so they add those two together and then they divide it by 2 to get an average. And then they take the sales, the net sales, and divide it by the average of the book value of accounts receivable. And they show that the accounts receivable turnover ratio is 8.3. So that means that we have, they actually will pay 8.3 times, like the amount gets paid over and over and over again. So on average, 8.3 times. So they're charging around this amount 8 times a year. That's what that ratio means. So on here are days of sales and accounts receivable. It's also used as days sales outstanding. We figure out, so we take our 365, divide it by that 8.3 ratio, and we see that every 44 days, those accounts receivables are paid for. So every 44 days, those accounts receivables are paid for. So that is, it's decent. It should be under 30. That's the goal. It should always be under 30. We don't want our clients to be out paying, 60 days or 90 days, because this means those are the days, that's the number of days that we're not getting paid. So we want to make sure that this number is closer to 30. So they have this and they look at that ratio and they look at it by year. So notice these are the different years at the top. It says accounts receivable turnover ratio, and then the days in accounts receivable. So we're actually doing pretty good. The days in accounts receivable are going down, which says to us that our customers are paying us faster. And we're able to recoup that money faster. So this is a good trend. This is a good trend. This is going down. That's a good trend. If this was 49, 50, 52, 60, that would be a bad trend, because then that would say that we're not collecting that money, we're not processing through, and it takes longer and longer and longer for our customers to pay us. So as long as the downward trends are good in this case, upward trends would not be. So that's kind of what we're going to be doing for this chapter. So we're going to be looking at those, writing off the accounts for a couple of the different types of methods, and then we're going to do a little bit of analyzing and looking at that information with the ratios and the turnover. So have a great week.